Good. So thank you very much, Stefano, for this introduction. So our panel is going to look into the status of the regulatory framework and whether it has proven to be fit for purpose and fit for the new challenges. And I think in the last few months, there had been numerous tests for the regulatory framework, both on the banking union as well as on the capital markets union. So just think about the crypto winter, the banking crisis, still the fallout from the war to Ukraine or COVID. So plenty of chances really to have reflected on where the status really is and whether there are any weaknesses that we need to address. So part of it will go into this direction. However, of course, what we want to explore is really the future. And what is coming up, what will be done until 2024, and what will be in the next legislative cycle. So I'm very delighted to have my panelists here that I'm quickly going to introduce. So Alexandra Jour-Schröder, Deputy Director General at DJ FISMA, Harald Waiglein, Deputy Director General in the Ministry of Finance in Austria, Francesco Mazzaferro, Head of the Secretariat of the ESRB, and Vittorio Grilli, Chairman of Italy and Chairman of the CIB division at EMEA in JP Morgan. So let's start, with the banking crisis. We recently heard from the CEO of a US bank that the banking system is stable and that indeed this part of the crisis is over. The stocks of banks have not really yet recovered, so there's still doubt apparently in the market. What we can observe, of course, was that this banking crisis from beginning of this year was rather affecting US banks as well as Swiss banks. So it was very nice to the EU banks, actually. So does that mean really that our system is so much better that it, did pass the test of this time? Or are we just not seeing the elephant in the room? Is everything still upcoming? And I want to start with you, Vittorio. As a practitioner and as somebody who probably can compare a little bit the US regulatory approach as well as supervisory approach with the EU approach. Was it really that EU regulation and EU supervision is very solid? Or did we just see individual cases of bank mismanagement basically to some degree in these banks that had been rescued?
Well, thank you, Sabine. Thank you, everyone here. That is a very important question. And since Silicon Valley Bank sort of a problem, a lot of analysis come out saying that, in fact, EU regulation and supervisory regime are quote unquote better, more resilient. And that's a problem like the one that we witnessed in the regional banks in the United States would not happen here. And I think I tend to agree. I think that the regulatory and supervisory environment in the US is different. And I think that there are in two respects. One, where you could clearly see that the US will have to do some work in the direction on how the European bank are regulated. I'm talking about some sort of a vertical homogeneity. Here we have in Europe that the rule book is the same for all the banks, big or small. And the way in which they are supervised are in a very integrated way from the center to the national central bank. But with the banks supervised at the center is about 110 banks, if I'm not mistaken. So all the large and medium large banks are all, supervised directly. In the US, on the other hand, you have, but the rule book is different from large bank and medium or smaller bank. And this is the weakness. Well, at least this crisis has shown that this is a weakness. The numbers of banks that are supervised at the central level is much smaller, much smaller. So there are a lot of quite sizable banks that are actually supervised at the state level. And that is this sort of continuity of supervision, regulation and supervision, I think is a big strength. On the other side, something that is not mentioned because it's not a question of crisis, but it's still an element of supervision is that, yes, United States may not be so well integrated vertically, but it's very well integrated horizontally, geographically. In a sense, what we have is a market in the US that is, basically one market, across the United States. While in Europe, we still see that host and home country, gold plating, and there is a lot of regulation which may be truly integrated vertically, but we go horizontally. That's not happening. And to me, this is maybe not an issue of panic or crisis, but is a structural weakness that prevents that kind of consolidation in the European banking sector that, in my own opinion, would be very important.
Thank you, Vittorio. Francesco, the ESRB has published a warning in September about the status quo at the time, the risks that you were seeing, and how to be vigilant. And it sounded quite alarming to some degree, of course. When I looked into notes to the board meeting of March, it sounded much more like confident, including statements that the financial system has bigger capital buffers and liquidity buffers, and is in a very different position than compared to the global financial crisis. And so the warning, of course, came before FTX was getting insolvent, and before we had the banking failures in March and April. So what is your take about the status and financial stability of the EU financial sector?
Well, thank you very much, first of all, for the invite. To a certain extent, our mandate is to look at tail risk and to look at what can go wrong. So it's by definition. And if I'm trying to reflect on the combination of the two things, the warning which we have been issuing in the course of last year, because we were seeing a number of, say, symptoms and episodes which were making us worrying about a darkening economic cycle. Then what has been happening most recently, I think that there are probably 3 areas where we think we would like to continue to work. One is the question of systemic liquidity. So liquidity in all the markets and the interaction which liquidity problems, misfunctioning of some markets, misfunctioning of the capacity of some institutions to fund themselves could have on the general financial market conditions. So the interaction between market liquidity and funding, which is of course exposed to a number of, very often unrelated topics and issues which may occur, but where you find that links exist. By the way, we are more and more thinking about the need of having a system-wide stress testing of liquidity conditions to try to understand what are the interactions between them. The second element on which we want to continue to work is what does it mean that in many regions of Europe, but also in the world, real estate markets are turning down. With, by the way, in some situations, the interaction of residential and commercial, which created a duplicity of, so to speak, of vulnerabilities. Also because at the very end, those which are building in the market are the same corporations, and with questions which have to do with the affordability of households, the situation of interest rates, the costs of the building activity, and the full dynamics, if you want, of real estate. And the third topic is inflation persistence and the interest rate risk, which of course we have seen as one of the fundamental topic in the United States. But of course, we should also consider not only as a banking issue. It's because the problems exist in the insurance industry. The question of valuation, which was mentioned earlier today, exists with investment funds. So one should really have a horizontal view, and not in order to establish a category of who is stronger, who is weaker, but simply according to principle of prudence, try to understand what is, what are the measures which exist in the financial sector to ensure resilience if valuations were questioned.
So what you didn't mention was, for example, that capital and liquidity requirements for banks need to be tightened further.
I don't think I would not make this statement in general terms. And by the way, also Andrea, who was speaking before, did not make this statement in general terms. We are asking also ourselves currently whether there are economies, to a certain extent, European economies are on some different tracks in terms of the future development, and there might be some of them in which it might be possible to activate macroprudential policies, like a countercyclical capital buffer or systemic risk buffer. But this would fit to some economies and would be completely wrong for others. One cannot make, there is not a one-size-fits-all argument there.
And if I can come back to your first point, the liquidity in the market, is that a question also of finally completing the capital markets union to get the deepness in the market and the liquidity there and have it improving?
The two things are related, but to a certain extent, what we are looking at as a systemic risk board is basically what are the incidents which may occur. The capital market union creates a framework, much welcome framework, where can, so to speak, further build the market. I mean, I think Minister Donna was saying this. So Europe is the place where the savers are. We are generating the saving, large part of the savings in the world. And we are doing this extremely generous gift to other continents of providing them the money to generate profits. We have decided to do it for many historical reasons, so to speak, but it's clear that you pay a price if you continue to do it for a number of generations.
Harald, maybe to you. So if you look in some of the cases on the banking crisis side, so Credit Suisse did not go into resolution. It was brought up and initiated by the government, for example. So the system that's in place in other jurisdictions has actually not been tested. Why was that the case? In the EU, would you think that our recovery resolution system actually would have been tested, would have, stand the test as well? So is it in good status?
I don't think it's in perfect shape, to be honest. If I make the comparison with the US and again, Switzerland is a special case because this was a GSIB that ran into problems. I would argue that a functioning regulatory environment for banks rests on two pillars. One is supervision with a supervisor that's not afraid to intervene early and decisively. And that's a precondition for the other thing, namely resolution to work, because resolution works a whole lot better if the supervisor intervenes early. Now, I happen to think, and Vittorio said it, we've really managed to create a top-notch supervisor in the European Union. Supervision in Europe works, whereas in America the system is really fragmented. You know, you have this entire business with state chartered banks, national chartered banks, the OCC, the FDIC. You could have an institution that's supervised by 7 different supervisors. That's what they call functional supervision. They're rather fond of it. I've always argued I can't see it working properly under extreme circumstances. And I think Silicon Valley Bank has proven me right in a sense, because this business model would not be possible in Europe. And the amount of interest rate risk in that bank's balance sheet would never have been possible in Europe. And as Francesco mentioned, I mean, if you have a held to maturity portfolio that comprises half of your balance sheet, of course you're going to run into problems if your deposits flow out. And then they have deposits that are extremely volatile, all from businesses. And I think that's the reason why they couldn't employ the resolution framework, which is actually their main advantage. This is their strong point. The FDIC knows what they're doing. It's a system that's proven its worth. And this is where we have problems that we need to fix in Europe. Our system is a bridge that extends halfway across a river. And if we encounter a case, you know, that just manages to be on the half of the bridge that's already standing, we'll do fine. But we may also fall off the bridge.
Alexandra, your view on the state of the banking union. It's not yet complete.
First of all, thank you for organizing this conference, because I think it comes at a good moment, because we start also to thinking a bit ahead of what we have, but let's perhaps for the moment stick to what we have. And maybe my first message would be that in general, we have a robust acquis in the system in Europe. I would agree with Harald, it's not perfect, but you know, the enemy of the good is the perfect. But that does not mean that, of course, we have to look into the details. 2 things. First is the regulatory framework. I mean, I'm well aware that some feel that the Commission and we all in the EU have the tendency to over-regulate, to somehow not be mindful to proportionality. But I think exactly now the situations we have seen, and they're all a bit different, shows that possibly such situations would not have happened in Europe exactly because of first of all, the legal framework we have in place. But that's only one part of the coin, because you can have the best legal framework, but if it's not correctly applied in practice, it's not really helping a lot. And here again, I would tend to agree what has been said, that an efficient structural supervision is the second big element we need. So when we look into and you know this all very well, the different pillars of the banking union, I mean, I'm very optimistic when it comes to supervision. I agree that on the resolution side, there are some missing elements, and we now try to fix it, at least partly, with what we call the crisis management review. But what is still missing is somehow a bit the European safety net with EDIS. I mean, I'm also well aware that this is, you have those who feel that it should come very quickly and some feel that it should never come. But I think we should not shy away from having this discussion, because in a real crisis situation, where psychology plays an important aspect. And if there is this understanding that there is a European safety net, I think that would also still much enhance the system we have. So maybe to conclude, no time for complacency. I'm really not the one who would say everything is good and let's carry on. But all in all, I think we have shown also now with the many crises we had with COVID, with the Russian aggression against Ukraine, and then the recent inflation and the recent developments, we are having a quite robust system.
Mm-hmm. So you said it, what everybody knows, that the banking union is not yet complete. And of course, banking union is one part of addressing prudential risk. The other part is, where is risk moving actually once we have the banking side properly regulated? And this is, often addressed like with non-banking financial institution sector. Francesco, ESRB is paying a lot of attention really to this part of the sector since years. What needs to be done there? What are your main concerns?
Look, I will tell the truth of what I'm thinking in this precise second. My problem is that exactly everything I wanted to say has been said this morning perfectly by the Vice President, by Vice President again. So my alternative is to repeat perfectly what has been said, or to try to speak, to make a consideration which is, so to speak, more general. But I hope it is still interesting. There is a place where the problems of the banking union and the problems of the capital markets union meet, and it is the market. Because banks are in the market and non-banking corporations are in the market. The market is elaborating all the signals which are coming, and is to a certain extent determining a situation of where risk is moving. There might be situations where the market is able to reduce the risk. There are situations in which the market is amplifying the risk. There are moments in which the market is shifting the risk. It would be extremely useful if the legislator in the next legislative term were able to have this horizontal view. The legislation which we have is very vertical. We have the banking union for banks, the CRD, CRR, we have EMEA, we have Solvency II. All of these things are, to a certain extent, segmenting the financial system vertically and creating a situation where it's extremely different to understand what is the congruence among them. If there were a possibility at a certain time to sit together, all the experts of the different sectors, and try to understand how we are able to do a legislative framework which is assigning the risk to the financial sector components which are able to absorb it, this would help us enormously. Because there are things which banks can do better than investment funds. There are things which investment funds can do better than banks. There are things which insurance can be better of the others. And so I really hope, speaking about what is coming in the new legislative term, because this is a bit the topic of today, that at a certain time in Brussels, the legislator will be able to have this broad view. So not only to review topics one by one, and very often very small one, the revision of 3 articles of the CRD, the revision of 6 articles of another, and this type of thing. But to try to make so to speak, an assessment of where we are. Have we been able to reduce risk? Did we shift the risk to the right counterparts? Do we risk to amplify the risk? Thank you.
Alexandra, you are the legislator. So maybe first, where do we stand actually in looking into this risk in the non-bank sector? And then how would you address what Francesco is requesting? It's not that easy.
No, it's not that easy, but no, I think Francesco makes a relevant point. And possibly, as you were asking about the non-banking industry, that may indeed be a case because it's very heterogeneous. But we may not have been able to discover all the risks. But let me perhaps start a bit differently, because first of all, everything that is non-banking is not non-regulated. I think that is also clear. Sometimes it's a little bit mixed up. I mean, we have the insurance sector is a non-banking sector and is very heavily regulated, and we have others. But it's certainly true that it's very, very diverse, posing different risks. I think what we have done, especially in the investment banking field, is quite elaborated. We have now also the review on the IFMD, especially to address a few issues that we found had to be looked after. Maybe the issue of money market funds needs a bit a second look. I mean, not in the way that I would think they're overly risky, but there may be something we have to look into, and that's possibly also something we will do in the next mandate. But coming back maybe to Francesco's point, I think what is indeed an issue is that, especially for the non-banking sector, we are not so perfect on the macro side, because there may be indeed risks taking these all together that we have not completely, maybe we have them on our radar screen, but not completely addressed in legislation. And there I see a bit of an issue, including also the interlinkages with the banking sector. And maybe there, if we could look more on the macroprudential side, if we need to address something via regulation that would more or less take this horizontal view, I think that is something I would tend to see this as a priority for the next steps.
Mm-hmm. Harald, can we turn to the crisis management part that's still open, and the proposal also of the European Commission that just came out? Where do we stand here? Is that something that we will still get over the finishing line until next year? What is needed to complete it? Is it a good proposal?
Whether we can manage to agree on it is a question beyond my pay grade, because then I would need to answer for France and Germany and others. I think it's the goal is the right one. We want. In my view, I think the ultimate goal should always be to arrive at a system that is very much like the FDIC. I mean, there's a reason why banks in the US follow different rules in liquidation than non-financial corporations. We don't have that in Europe. We have the same system for banks and non-banks, unless they're going into resolution. I think that's a problem. And EDIS, Alexandra mentioned it in a way, the SRF is half an EDIS because it fulfills many of the functions of the FDIC in the US, but not all of them. And we need to think about the rest. So in that world, anything that brings us closer to that objective, one fund for European deposit insurance and resolution, one system for all banks, anything that takes us, brings us closer to that goal is fine with me. And in that sense, I think the proposal pursues the right goal in saying, let's broaden the scope of resolution. That's fine. Where I would see the biggest problem in substance is the least cost test. Because the FDIC system is based on the premise you pursue the path and resolution that's the cheapest to the fund. Now, obviously, in Europe, we don't have one fund. And the CMDI now tries to address the national deposit guarantee schemes and the single resolution fund. But the least cost test will only be looked at the level of the national deposit guarantee scheme. So the natural incentive for a national deposit guarantee scheme is to shift the problem to the SRF, which would be fine if they had a proper least cost test, but they don't, because they never apply bail-in on unsecured deposits and senior bonds. And that's not the ideal way of resolving a bank. So in that way, the system is tilted. That's a fundamental problem that I see. And I don't know how we can solve that. I mean, the least bit that I was thinking about is, okay, if we want to have contributions from the deposit guarantee scheme in a resolution, those contributions should only cover the gap that an institution cannot fill to the 8% of minimum bail-in. But it can't replace them. It shouldn't replace them, because that would be a way of circumventing the bail-in system that we have established so far. That would be the bare minimum. But I'm not sure that's enough for other countries. So I'm just focusing on this. That's my fundamental problem with that proposal. Mm-hmm. But there are many other issues that we could discuss.
Mm-hmm. So, I mean, do you think we would be actually in the EU in a position that this run on the bank, on Silicon Valley Bank, for example, where within 24 hours an enormous amount of deposits was withdrawn, that we would not really have this in the EU, that there would be confidence basically in the system too, and enough security in the system?
I mean, it's a good question in a sense that social media seems to speed up things. On the other hand, from a historical perspective, I personally can't think of any case where a banking panic was caused, just by rumors without a fundamental underlying problem in a bank. Mm-hmm. And in those cases, bank runs tended to be concentrated on that bank or other banks that were perceived to have connections to that bank. Mm-hmm. But the panic never spread to an entire banking sector that was not connected to problem banks. Mm-hmm. So against that background, I'm pretty confident that we could manage such a situation. I mean, we've had situations like that in the past in Austria, and our luck is that we have a very well functioning insolvency system. So when a bank runs into trouble, we bail in everybody basically, and we sell off the assets as quickly as possible. And that worked well in the past, but it only worked well for smaller institutions. Mm. We never had to do it with a big, in fact, we never dared to do it with a big institution in the financial crisis, because that would have blown the system apart. Mm. So that's the problem, and that's what we need a European resolution, a functioning resolution framework for. Mm-hmm.
Good. So let's turn to capital markets union, actually. And Vittorio, you mentioned at the beginning of this discussion here that unfortunately markets are still fragmented, or the banking system is fragmented, but markets for sure are fragmented. Was it actually like a positive thing in the banking crisis that it was fragmented? And, if not, what needs to be done to make it more holistic?
Yes, thank you. And to answer that, let me try to give an answer to the second question that you asked me in the first turn that I didn't answer, whether there is some elephant in the room that we are not seeing and that will put threats into the financial system, banking or not. I think there are not really elephants, but I think there's been a phenomenon or development in the financial market that needs considering. One is the role of treasuries, sovereign debt in the bank's balance sheet. There always been a lot. There will always be a lot. In the past was considered the risk-free asset, like nothing bad could happen to you. And instead we saw first in the great financial crisis that a lot of the great financial crisis was like, in a sense, exacerbated by the presence of and the balance sheet of sovereign debt. But here we had another phenomenon. It was not just an issue of potential defaults. Here was just market volatility in the treasury that generated additional problem in the bank that held them. So I think that sovereign debt has been increasing everywhere. So there is going to be a lot. And I wouldn't define it risk-free asset any longer. So the way in which we look at it within the bank balance sheet, I think, need further thoughts. The other one is really technology. I think technology has changed the bank sort of ecosystem within the banks and outside the banks. Harald just mentioned social media. I mean, clearly social media alone cannot generate a bank panic, but clearly they are a huge accelerator. And the way in which you interact with social media and the way in which you take stock that they exist, I think that is part of an important reflection that we have to do within the industry and within the regulator and supervisor. But technology has changed the way in which banks operate in a deep way. I mean, you mentioned the huge run and in deposit. You know, now if you look at the previous big run was Washington Mutual, you know, during the great financial crisis, and that took 10 days to withdraw 15 billion. Now here it took less 1 day to withdraw 42 billion. You know, so that gives you the idea that the way in which now depositor can change their mind has accelerated a lot, which this looks like an issue for panic, but it's not. And the point that I want to make is nothing to do with panic, is how sticky are deposits? Because much of the banking business and the profitability of the banking business is based on that, you know, that deposits are sticky. Now, I think Europe is a little bit behind. I mean, I think the level of stickiness of deposit in Europe is higher than what is already is. I think that in Europe, even right now, they're still enjoying it a lot. In America, much less. So I think that even profitability in the medium term will change, which means that, you know, the business model of bank will have to evolve because of technology. And here, if we put that together with the capital market union, you know, banks are not, you know, the only player in the ecosystem, and unfortunately, they are still the largest player in the European ecosystem. So capital market union is about enlarging it, you know. Now here, I will make 2 points. One, which are basically, given that my role here is also to bring industry concern, you know, 2 concerns. One is the way in which we go into creating or maybe, you know, strengthening a capital market union, which I see completely are not 2 separate issues. Banking union and capital market union are part of the same picture. One is this strategic autonomy issue, which is, I think, we all know where it comes from. We all know that I have a deep justification after, you know, COVID crisis and so on, that you need to have resilience in the system. But I think that strategic autonomy is not a goal, is the way to make sure that your system is resilient. And then you have to look at what sector we are talking about. And I think that the point that will make financial sector is a special sector, because the strength and the autonomy, strategic autonomy of a sector doesn't depend on the strength on an institution, on a company, is the strength of the network. Because the way in which bank operate, financial institution operates, is whether they are part of resilient network. And so we have to be careful when we think about strategic autonomy that we don't damage the network. We don't limit the network. We don't make our network smaller than it should be, but it's with much less connectivity with the global world. And I think here there is some misconception, the idea that maybe international banks, where they go and get tough, they disappear, you know, which is not true. If you look at objectively the data during the COVID, you know, frankly, the amount of European exposure by international bank have not changed. Actually, in some extent, in my case, in our case, have increased, you know. So it's not true that when the going get tough, you only think about going home, you know. You think about how your bank will survive better and more profitable in the globe. The second part is, frankly, something that people tend to forget, but to me is a big bridge between banking union and capital market union, which is securitization. Securitization is a bad word now in Europe. You know, people don't want to talk about it, you know, given that we clearly have bad experience coming out of the great financial crisis. But to me is an irreplaceable tool, which is what makes somehow financeable in an easy way, non-banking institution, and how banking institution can clearly use that to unload for the balance from their balance sheet, loan and so on, and start fresh. So I think that the two things, without having a rethinking in a better way about what securitization means and how it can be used, I think that capital market union cannot be developed properly. So I'll stop here.
Alexandra, was that enough in terms of inspiration to develop the capital markets union? You had this complaint, I think, both at the dinner yesterday and today in some comments in the audience.
Yeah, first of all, I think there cannot be enough inspiration when it comes to great ideas how to make it a true capital markets union. Maybe just going one step back, I think it's still always good to be mindful. I mean, we are operating in a system with 27 independent jurisdictions. I mean, we have, of course, harmonized quite a lot of laws and legislation when it comes to the financial sector. But I think we should also, when we speak about capital markets union, not only look at the financial sector regulation. And I think there I see quite a lot of commitment, also maybe if needed to go a step further. But where I see some difficulties, it's when we get to other elements of the national jurisdictions. And that is especially when we have now the insolvency proposal on the table. I have to say it's going very slowly. A bit disappointing, but remain optimistic. But even there, what the Commission has put on the table, this is just a part of what actually should be regulated to give investors the necessary confidence. Okay, if something happens, the insolvency system applies across the board, and in Europe, it is the best system you can have. So I think we are very far away. What is also an issue is, of course, and that brings me to the first remark of Vittorio about, let's say, the liquidity of all that and the jurisdiction across the board is about pension. I mean, I think that is in Europe one of the biggest problems we have, that we have very many different pension schemes. People slowly realize that it's not only the state who will finance their pensions, that there is a private investment needed, but how this should go is very diverse. And that I think is also one of the causes that the capital market union in the US is much more developed, because people put more of their private money in the market to save for the retirement age. So I think that is an issue, but I'm also realistic that this is not so easy to do. But maybe this is also the moment where policymakers should really ask the question, I mean, are we working on the right issues? I mean, I see possibly still a couple of other points in financial market regulation. Yeah, I think we should speak about securitization. It shouldn't be a taboo, and it has also changed a lot. I mean, it unfortunately got a very bad credit after the financial crisis. But I would say the situation today is quite different. And I mean, we have done some reporting and some analysis, but it's certainly something one should look into. But there may be more issues. But to conclude, my point would be that possibly to take this very seriously about capital markets union, it's not only about financial regulation.
Thank you. So let's touch in the final minutes before we open for discussion here on two other of the big projects really in the EU, and that's sustainable finance, ESG, as well as digital and crypto. And we had an entire panel around digital and crypto and innovation. But Francesco, the ESRB is about to publish a report around the systemic risks that could come from crypto assets and related environment, basically. Is there something that you can say already to this report? What is the background?
Thank you. I would say in 30 seconds, I wanted only to take the occasion to make a very small reflection about something which we have been collectively saying. The first Federal Reserve was created a few years before the First World War, despite of the fact that the dollar existed since decades. There had been even a civil war. Somebody has been winning the civil war. The winner of the civil war even didn't have the political force to create a Federal Reserve. The Fed was created first before the First World War, but the prohibition of cross-banking lending was abolished in the 90s by Bill Clinton. And the same happened with the abolishment of the Glass-Steagall Act. So the Fed was created at the time in which the United States had even not been fighting in the First World War. It was a regional power, which was considered lateral, a folklore type of things by the Europeans at that time. And what we consider the banking union was created at the time in which the US was the first superpower, had won the Cold War, and had the capacity to intervene with 2 or 3 armies in the planet at the same time. So this to say that we need some patience. We need some patience. So we cannot think that we will be able to do in 5 years what the United States have done in decades and decades. Okay, so it's now on the question of the crypto. So we have been looking at this with the idea to say, is there another monster? Is there another systemic monster which is going to ruin our nights, so to speak? And what we have discovered so far is curious, that the reverse of what we expected has been happening, so to speak. The crypto industry is being ruined by the fact that they deposited their banks in bad traditional banks. Okay, so instead of being in a world in which there was a new super asset which was creating a new type of so to speak, of vulnerabilities. So far, crypto has been creating problems to itself with the crypto winter, but we have not been seeing a lot of connections with traditional finance. And we will continue to monitor what is happening. But for the moment, the first request which we will have to the legislator is to create a mechanism of reporting, because this we don't have, to have the data, because at the very end, which is the problem, we don't know. Okay, so we need to and then of course we have to continue to look at issues and try to understand. For instance, there are very specific questions. So there may be leverage through crypto. These are questions which may, but by and large, crypto seems to be for the moment interesting from the technological point of view, boring from the banking point of view, because they do with new names what has been done by others for centuries, including criminality, including stupidity. So you can be a crypto stupid exactly like you were a traditional stupid in the previous part of so to speak, of the life of the mankind.
Mm-hmm. Harald, some words to the digital euro from your side.
Okay, I'll choose my words carefully, but I already know that my friends in our central bank will hate me for it. I think the one big question that we have yet to answer when we discuss the upcoming legislative proposal for the digital euro is, what is actually the value added to the retail consumer? Because we have e-money already, people can pay with e-money all across Europe. In what way will the digital euro be different? And I mean, I haven't heard any satisfying answer to that yet. Not even the obvious one that it should be cheaper, because we don't know the funding structure. We don't know who will fund the network for payment services for the digital euro. And we don't know what, because it will have to be done by financial intermediaries. but we don't yet know what the business models are of these for distributing the digital euro and what they'll charge. So I think we can say very little. And I know there are very good arguments. I hear them from central banks all over the place that we need to ensure that monetary transmission will still work when there's no longer cash, which is all well and good, but it will certainly not turn the electorate in Austria. And I doubt it'll turn the electorate elsewhere because people just don't care about monetary policy. I mean, they should, but the sad fact is they probably don't. And if we don't have that case, that very good argument, I'm a bit worried that this legislative file will hit us just in time to become an issue in the upcoming European election. And I'm not sure that that'll be pretty.
Okay. So cautious, to summarize it.
Many open questions. I mean, instinctively positive, but there are many open questions.
Yeah, okay. ESG, Alexandra. I mean, EU was leading on this globally since many years in the meantime. And there remains quite some things to do. But in general, I mean, what the Commission has been initiating in terms of getting the data, looking into supervising whoever handles data providers, rating providers, etc. That's currently on the agenda. So where do you see these things going? Like, I think we are expecting a proposal any day now in terms of legislative proposal, right? And but will it still cross the line in 2024? And what will be the next steps really for the next legislative period? Very short.
Yeah, I try to do this in maximum 2 minutes, which is really a challenge because there is a lot to say. Now, I mean, try to keeping it short. You're right. I mean, we have been certainly in a front runner when it comes to ideas how to channel private money into sustainable projects. That should not mean that there is no public responsibility anymore, but given the massive amount of money we would need to really make the step, we had to think about a system that is attractive and works. I mean, my main message on that would today be that we are in a process of making this system usable. And I think there is, of course, a bit of a concern that there's always new ideas, and that it is good that there are these new ideas because we have to be innovative. But I think it is also important that we give a bit time to the market to apply the rules and to see what works and maybe what does not work. And I have to say I'm very self-critical in that. And if we realize, okay, something is simply impossible to introduce, we have to make it fit. So today I would say we have put a lot of the table, good reasons, but let's focus a bit on simplification and usability and then take possibly the next steps, but depending on how we see the system works. Yeah, that was very short, but
Vittorio, last word on ESG from your side. EU frontrunner, but internationally, of course, you know, other countries are following. Even the US is looking into it. I mean, is it maybe the case that part of what the EU needs to do, I mean, not only let things sink and you know, see how it works, but literally also to look what happens outside of the EU in terms of alignment then and reaction, and how do you see customer demand really?
Absolutely. I think that despite what regulation are, I mean, we see that the sensibility all around, both of client, customer about the issue of sustainability and really the green agenda is part of everyone's mind. So, and I think that banks and international banks as a good citizen also because frankly, this is the largest sort of potential business in the future everywhere is a lot of attention. But as you mentioned, there is a need of a lot of alignment, you know, and I think that here the most difficult part is the business what you really need to help is not what is already green, what is not green and is trying to a transition. And here there are a lot of gray areas, okay? And I think that is right that politics and politicians worry about, are we giving the money to the right people, to the right industry? Are we avoiding the moral hazard of all of that? And I think this is a well-posed question, but then how you implement that, because that's very complicated. And we need when you mention alignment, it's not just international alignment, it's still legislation in progress, but there is already lack of alignment from what we see within Europe. When you basically say that each country can implement somehow how they want it, for financial institution is a nightmare, not only globally, but even within the European Union, and I think there has to be common standard across, otherwise the level of complexity and bureaucracy that you'll have to face is going to be humongous. And plus, and this is my last comment, given that time is over, you cannot ask, in my opinion, too much of financial institutions. So you cannot ask financial institution to be the guarantor that the money which is lended is actually going to go to exactly what the company say we're going to do. I mean, I think that there is an issue of transparency, there is an issue of checking, but if you ask bank to do also that kind of job and be legally somehow accountable for, is a nightmare. Not to, and last point is right now in the legislation that we see now is that if you do business in Europe with a big enough entity, then you are liable to use the same kind of due diligence, also business that you go do outside Europe, which is, clearly, if you do business in Europe, then if you lend money to somebody in Missouri, you should basically use the same standard procedure, which is, I think, probably is a question of complexity in the making, in the drafting, but there is a lot of streamlining that needs to be done, because it's a huge and very important part of our economy right now.
Yeah. Talking about streamlining, we have one question here from the audience. More than 45 EU supervisory agencies for one US bank. Do we want more centralization on the side of national competent authorities, for example, a bigger role of ESMA?
45 EU supervisory agencies sounds a bit scary, I have to say. Yeah, I think we have to, and it should not be a taboo to still speak about the benefits of EU centralization. It's not a purpose in itself. I think it's not to create central supervision, because there should be a lot of EU agencies over the place. It's sometimes a question also to facilitate things, to avoid the home host discussions, as it was said by the president of the Eurogroup, to get to further harmonization. But I wouldn't see this for the moment, but I understand that it can be a nuisance for those who are supervised, but I don't see so much happening that we will have a lot of new agencies coming. We will have possibly an anti-money laundering agency, so maybe that helps already a little bit the person who has asked. But otherwise, I think it stays somehow on the table, but it's not something for the very short term.
And then, yeah.
I would like to make a link between the two questions.
Yeah.
I don't know, because I have in mind what Andrea Reed told us a few minutes ago. He told us he does not feel that the industry is pressing enough in favor of change and in favor of Europeanization of the financial sector. It is clear that if in the morning, I'm speaking of a completely honest politician, the first phone call he gets is from somebody of the financial sector who tells him, you have to defend myself from Brussels, the way in which this person will learn to reflect that his duty is to defend the industry from Brussels. If the first phone calls is somebody tells them, look, I'm getting mad because there is so much fragmentation that I need somebody at the European level to take a bit, let's say, a more coherent responsibility. Also, the politician will start to think, oh yes, my duty is to make sure that my people are protected in the sense that they are not lost in the jungle. So I think it's not a technical question. This is a political question, isn't it? And a question of how society is reacting. And we have a collective responsibility. So if we believe in Europe, we have to bring forward European struggles.
Can I make a point on, which also what Andrea and Ria was saying, is true that maybe there is not enough sort of a demand from the industry for bringing forward the integration. But I think that here I see it, maybe a little controversial comment. I mean, I think there are, let's talk about banks, the large bank institution, the one that could be the consolidator. Some of them tried and somehow, quote unquote, failed because, you know, the benefit of running a potential pan-European bank were not smaller than the cost that they face because of what we say, gold plating and so on. And then there are a whole other number, which are the majority, which are not going to be the consolidator, but the consolidated. And I think they like this environment because this generates protection, you know? And so I think that here you need vision at the political level. You cannot expect, you know, the industry to do that kind of job. You need a vision, you need a plan, and to move it forward, because in my opinion, the large part of the banking institution, they're thriving like that. They like to have their own domestic market protected, and they are not thinking about consolidation. I think consolidation is, frankly, a vision from you know, leaders like you. I don't think you can ask too much from the industry, but this is my own opinion.
Good. Did we somehow address the second question here as well? Now, horizontal approach to policy making help to overcome national vested interests? I mean, in a way, you know, we did probably with your comments here. Which means I think we can conclude this panel. And my last question is like one word or expression. What is the next big thing like in 2024 for the new legislative period? Vittorio, we start with you.
Well, I think what we said before. I mean, I think that more the new ideas, because there are plenty of very important things on the table, is a changing pace. You know, that is frankly, which I would agree is very much political. You know, and then you need from the capitals of Europe to have really their own changing pace and betting on Europe more than they have done up to now.
Francesco.
I think the real game changer is the initiative of 8 governments of the European Union to propose the transition to majority vote on taxation and foreign policy. If this goes through, it will be a game changer also for finance. It will create a really political traction towards more political union.
Well, I think I lack the imagination for the next big things because we're still stuck in the past big things. So I very much hope that we'll see an additional drive on banking union, because even though that's politically difficult, we can, if we agree, we can order banking union by decree, which is not something we can do with the capital markets union. We can't decree a market to exist. So I hope that's going to happen.
Alexandra?
Yeah, as time is running out, maybe just 2 words. I think what we need is what I would call a sustainable competitiveness. That does not mean that there is a the free market, but the stability aspect is taken into account. That why I added sustainability, but I think we always have to keep in mind that we have to have a competitive industry in Europe.
Good. Thank you very much to my panelists, and thank you for listening to us.